Welcome to Consultants and Money, the podcast for solo consultants who want financial clarity without the overwhelm. I'm your host, Erica Goody, CPA, bookkeeping, and CFO partner, and a fellow corporate ship jumper who built a business with balance in mind. Each week, we talk about the real money stuff, from keeping your books clean to calming cash flow chaos, saving on taxes, and planning for what's next, so you can focus on your clients and enjoy your life. A quick note, this podcast is for educational and informational purposes only, not financial, accounting, or legal advice. Be sure to talk to a professional who understands your specific situation before making any decisions. Hey, welcome back. Let's talk about the thing that happens in business that no one is talking about because it feels embarrassing. No one is bragging or humble bragging about this on LinkedIn or Twitter. You pull your profit and loss report, see that your business made money, but your bank account still feels tight. Or maybe worse, you have cash in the bank, but you don't feel confident pulling money out of that bank account to pay yourself, even though your business looks profitable. Today, we're digging into that disconnect, why profit doesn't equal a paycheck, and I'm going to share a simple framework I use and recommend called the 50-25-25 rule. It's a tool to help you take home consistent, sustainable income, even when your business revenue goes up and down, as it often does in consulting work. Okay, let's get into it then. Profit isn't the same as a paycheck. One of the biggest misconceptions I see, especially with consultants and small agency owners, is thinking that whatever's left in your business after expenses is yours to spend. Now, technically, yes, that's your profit. That's what you're going to pay taxes on, more or less. But that profit still has a job to do, actually has many jobs to do. Before it becomes your take-home pay, it needs to cover your tax liability, create a reserve in your business, and ideally smooth out your income during slow months. That gap between profit and paycheck, that's what we're going to close today. And by the way, you're not doing anything wrong if this has been confusing. Most people have never been taught how to use their profit. They've just been told to track it or pay attention to it or whatever else they may have heard in some book or podcast or LinkedIn post. This episode is about what to do with it. So here's the 50-25-25 rule. This is my personal recommendation based on the current tax code and what I've seen work well in building sustainable W-2 style consistency for business owners. And remember the disclaimer at the beginning of this episode. This is general advice, not specific financial or tax advice for each individual listener of this podcast. This is just a general starting point. Here's the basic idea. When you look at your profit for a given period, not revenue, but true profit after expenses, you divide it into three parts. Number one, you want 50% going to your owner distribution. That's going to be your quote unquote paycheck. Now, if you're an S Corp, there's going to be an actual paycheck, but we're going to talk broadly in LLC standards here. It can be monthly, biweekly, whatever rhythm feels good for you. This is money you can move from your business account into your personal account. The next 25% is going to go to taxes. This covers your federal, state, local, self-employment, all of those tax responsibilities. You're prepaying what you'll eventually owe at tax time. This isn't exact, but it's a solid starting point. And the final 25% goes to your business reserves. This is your business's safety net. This might fund a slow month, help you invest in a new hire, or you could even use it as an additional owner distribution at the end of the year when you feel like you have a big enough reserve in place. Now, these percentages aren't carved in stone. They're a starting point, but they work remarkably well, especially if you're trying to create more steady, reliable income from a business that's anything but predictable, like consulting income can be. So how do you actually calculate this? This part is key. If tax season always sneaks up on you, let's change that. I help solo consultants clean up their books, get clear on cash flow, and plan for taxes, so you can head into year end without a single surprise. Here's how it works. Go to ericagoody.com, fill out the connection form, and we'll book a no-pressure free meeting to see if we're a good fit for each other. I'll leave a link in the show notes. I want you to use a rolling average of these numbers, not just last month's numbers. When I say take 50% of your profit, I don't mean look at just last month's profit. Because if you're a consultant or an agency owner, you already know one month might be huge, the next one might be quiet. That's the nature of the industry. So when you apply the 50-25-25 rule, you're going to do it based on either a rolling average of your last 3 to 6 months of profit, or if you're forecasting, you're going to use a forecast of your expected profit for the next quarter or year. And I'll drop a link to a recent episode we did on forecasting, episode 103, Forecasting for Real Life. The goal here is to smooth out the roller coaster of consulting profit, not just ride the roller coaster every time. That's how you start paying yourself a consistent amount, even if your business revenue is inconsistent. Now let's talk about the tax piece a little bit deeper for just a minute. That 25% for taxes is a general rule of thumb, but your actual tax rate will depend on two big things. Number one, where you live. A portion of this 25% for taxes is going to go to federal and a portion is going to go to state. So where you live matters. If you're in a state like California, New York, Oregon, you're probably going to owe more state and local income tax than, say, someone in Texas or Florida or Wyoming where there's no income tax. Number two, another big factor is going to be your household income. If you own a small business, but you have a spouse who earns income as well, especially if they earn a high income, or you have rental income or investment income, any other source of income, your total household income on your tax return might put you and your business income in a higher tax bracket. So that 25% might need to be closer to 30% or even more. Or if you're in one of those no income tax states, it might need to be less. It might need to be closer to 10 to 15%. The point is, use the 25% as a starting place and adjust based on what your tax preparer or fractional CFO sees as years go on. This whole framework isn't about bookkeeping. It's about creating calm. Here's what I've seen it do for clients and for myself over the years. Take-home pay stops feeling like a guessing game. Tax season becomes less scary. And big decisions like hiring or taking a significant time off from your business gets a lot easier to evaluate. You can go from asking, "Can I afford this?" to saying, "Let me look at the plan." It's like creating your own version of the direct deposit you were used to when you worked for someone else. It gives you a rhythm, and rhythm builds stability and confidence. So here are my final thoughts on this. Profit is great, but if it's not translating into a stable life for you, into actual money that shows up in your personal bank account at the same time, in the same amount every month, then something needs to shift. The 50-25-25 rule is just one way to start building that shift. And again, this is my general recommendation, but it works really well for a lot of consulting and service-based businesses, especially when you're starting out or trying to start out creating some consistency. Try it out, adjust as needed, and most of all, give yourself permission to build a business that supports your life, not the other way around. Thanks for joining me today. If you found this episode helpful, share it with a fellow consultant who might need it too. And until next time, here's to cleaner books, calmer cash flow, and more time for what matters most to you.